Hello and welcome to Portfolio Matters, weekly markets checklist, week 144. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Okay, before we get going, some housekeeping. I'm afraid that this will be the last Portfolio Matters for 2 weeks as Richard and I go hiking and then skiing. It's a hard life. But next week, instead of the usual weekly markets checklist, we will be running a podcast of lessons we learnt in 2023, which I aim to get out next Friday. So no weekly markets checklist for 2 weeks, but I hope you'll all check out our lessons of 2023. Okay, news this week. Well, tensions in the Middle East. So yesterday, Iran seized an oil tanker off the coast of Oman, apparently in retaliation for the US having seized an Iranian oil tanker last year. And the Houthi rebels have continued to be firing drones at shipping in the Red Sea. And yesterday, the UK and US attacked Houthi rebel sites in Yemen. All that adds up to disruption to world trade and fears over disruption in oil flows and rising oil prices. We'll show you the data later. And while we talk about energy, UK electric vehicle penetration actually stalled in 2023. So only 16.5% of new cars were EVs, down from 16.6 the previous year, and actually only 1 in 11 private buyers chose an EV. So the EV revolution doesn't appear to be making much progress. When government subsidies fall, so do people's appetite for EVs. Now, turning to the...
I was going to say, I think one of the big issues, people are very concerned about charging points, aren't they, Keith? Because on a long journey, you can't charge your car.
Well, absolutely. You know, we have a big old Renault Espace, which has a range of 800 miles. And, you know, what's the range of an EV?
Yeah.
US Fed Governor Lori Logan stated that QT may slow as the reverse repo facility becomes exhausted. Reminder, the Fed is currently selling down its bond portfolio. And in the EU, the ECB vice president has warned that the EU is headed for a shallow downturn in Q4, while inflation show a temporary resurgence, and he pushed back on near-term expectations for a cut in interest rates. Elsewhere, and I didn't know this, on the 1st of January, the BRICS group of nations expanded to include the UAE, Saudi Arabia, Iran and Egypt. So the BRICS is expanding as a counterpoint to the G7. And finally, the SEC has approved its first Bitcoin ETFs, and Bitcoin like that. So some charts relating to the news. Well, UK mortgage rates have actually fallen from their peak, with the 2-year rate now down to about 5.9%, down from a peak of 6.85%. So hence, there has been a pickup in UK mortgage approvals. Now, we've had a big sell-off in bond markets at the start of this year, and that has tightened financial conditions again, although they remain pretty loose, quite honestly. So the red bars here are the reverse repo, and as the reverse repo has been wound down, so the Fed has been pushing liquidity into the system, and in order to balance that, it has been doing QT. So you can see the two roughly balance each other. So hence, as the reverse repo becomes exhausted, the Fed no longer needs to do as much QT in order to stop liquidity rising. And this is the BRICS, which has expanded all around the world, essentially, to try and it seems like it's an attempt to contain the influence of the G7 and the dollar bloc. So in the coming lessons of 2023, one of my lessons is that US sanctions are no longer effective.
Yeah, and also they damage the US possibly more than they damage the sanctionee.
Yeah, I agree with that. And this is Houthi attacks on shipping in the Red Sea, and it is traffic going through the Suez Canal, which has dropped very substantially. So that is going to disrupt global trade supply and may push prices up temporarily. Frankly, the markets got a bit ahead of themselves in late last year, expecting rate cuts as soon as March, which seemed a fantasy, and they have now rode back on that a bit. And this is Brent, which rose, but not that much on the disruption in the Middle East. Okay, on to this week's economic data and the UK, Richard.
Thank you, Keith. UK GDP month on month up 0.3%, a little bit better than expectations. And UK GDP year on year, basically no growth there. Nothing to see here, unfortunately.
Yeah, I thought the fact they've revised down the October number by so much was interesting.
Yes.
The state of UK statistics.
UK manufacturing production, a little bit better in November than over the summer.
Yeah, it breaks the run of 4 months of falls.
And UK manufacturing production year on year. Of course, I mean, you'd expect these things to be pretty much zero because of the year on year GDP change.
Yeah.
And industrial production month on month and year on year. So, yeah.
Again, that's a big reduction in revision to the October number.
It is, isn't it? Yeah. And month on month, construction output was actually down 0.2% in November, following a fall of 0.4% in October, which doesn't surprise me. I mean, you should look around London. I would imagine there's been a huge number of projects waiting to be completed. I'm not sure whether there's so many being started because of the issue with commercial property.
Yeah, I mean, this is exactly what you'd expect to happen with the rise in interest rates, which discourages investment. And with a lag, lots of projects which were started with cheap money are completed and they're not replaced.
Yeah. The UK balance of trade is as normal, negative. And wouldn't it be nice if we could actually get some consistent positive in normal times as opposed to in COVID?
Yeah.
And UK Halifax house prices actually going back up in November and now in December as well. So we've got a little bit of 3-month run of price increases. Mostly, I think, driven by shortages in housing. And house prices year on year have broken their duck, i.e. got back above zero.
Yeah, I'm just, again, absolutely amazed. Given housing affordability in the UK is absolutely dreadful at these interest rates. But I was out last night with a friend who was pointing out that only around 30% of UK houses are owned with a mortgage. So 70% of homeowners don't have a mortgage. Amazing.
Yeah, I didn't know that. And the UK Global Construction PMI is 46.8. A slightly better consensus, but actually slowing down.
Yeah, still contracting.
Yeah. Retail sales year on year are continuing to grow slightly sluggishly.
Yeah, remember this is nominal.
Yeah,
So it's
yeah.
growing less than inflation,
I
and
always forget that it's nominal.
it missed expectations in December, and all the commentary is that actually kind of retail sales were poor in December.
Yeah. The UK mortgage rate. I don't quite understand this now because I believe you can get a fixed rate mortgage of about 3 to 4% at the moment.
Yeah, I know, Richard. I believe fixed rate mortgages 2 year about 5.9%. We showed the figure earlier.
Right.
But I think this is the standard variable rate. And I think basically nobody pays it.
Yeah, so it's a bit misleading, isn't it? I mean,
Yeah.
it is a rate, but it's misleading. Really, what you need is a sort of is an average of all the
Yeah,
rates that they were taken out at.
agreed.
UK City Group Economic Surprise Index. As everybody knows, I think this chart's too noisy to be useful. Keith likes it.
Yeah.
Shows the way up. We must think differently in this regard, Keith.
Mm, yeah.
I don't know what it's telling us because it's so noisy. Keith may have a view, though.
Well, it shows that the data is coming in worse than expected currently. But I agree it is noisy. And actually, my enthusiasm for this chart has been slightly tempered by the fact that, when you look at the gray bars, which are recessions, well, the data's all over the place. So it doesn't, yeah. Anyway, I still quite like it.
That's fine, Keith. A lot of people must like it, or they wouldn't bother creating it.
Yeah.
UK food inflation is continuing to fall, only 6.7% year on year. But overall price inflation is 4.3%, which is still not too high. And so it's, in summary, I shall summarize the summary. The economy is sort of resilient-ish, but it's not. I think it's pretty sluggish, really. We've still got a negative balance of trade, well, it's better than expected. But house prices are actually very resilient and defending themselves against the interest rate increases.
Yeah.
So, yeah, stuck in stagnation. It does rather look as if we are stuck, doesn't it?
Yeah.
The way out of it is a big tax reduction, a la Liz Truss. However, it needs to be managed in a much more sensible way. This is just my personal view.
Well, I fear the Tory government just doing these unfunded tax cuts. We're running a ridiculous deficit. We can't keep on increasing it. They have to start cutting spending if they want to.
We are in a debt trap, Keith, aren't we?
Yeah, yeah. But anyway, with interest rates as they are, the UK economy is not growing. Is bottom line.
No.
And onto the EU. So we had EU inflation numbers out for December, and inflation bounced back, I'm afraid, up 0.2%, slightly higher than expectations, and much higher than the drop of 0.6% in November, which is extraordinary. So that left year-on-year inflation in the Eurozone at 2.9%, a big bounce from the 2.4% in November. But a big part of the bounce was comparators of base effects with last year when there were German energy subsidies, which have since rolled off. Core inflation continued to decline, falling in line with expectations, and that is good news. And if you dig down into the numbers, then really there's very little inflation. If you look at the last 3 months of core, you're talking about 1.2% annualized. The construction PMI bounced a touch from November, but was below expectations and is still a pretty dreadful number. Construction in the Eurozone is in recession. Retail sales in November fell in line with expectations, but that's not a great number. And if you look over the course of the year, then Retail sales have been falling fairly regularly and year on year down 1.1%, which was slightly better than expectations, but still down on October. Economic sentiment, though, bounced. I don't know why, but people are feeling a bit more optimistic. Consumer confidence bounced. And bearing in mind, Eurozone citizens are always pessimistic, that's a bad but not dreadful number. Inflation expectations, that's decent enough. That is lower than pre-pandemic. Selling price expectations going nowhere, very low. Services sentiment picked up. And actually, that's not a bad number. Not great, but not terrible. I found this absolutely astonishing. The unemployment rate in the Eurozone ticked back down to 6.4%, i.e. the cycle low. Now, I have had a look at the unemployment rate in Germany and France, both of which are rising quite sharply. So I can't quite see how Eurostat have got this number. But the picture is of a tight labour market in the Eurozone. The Citigroup Economic Surprise Index, minus 16, better than last week, but shows that the Eurozone economic data is still missing expectations. I thought this was interesting. So this is experimental data from the ECB showing the Gini coefficient. So reminder, 100 means perfect inequality. 0 means perfect equality. And so inequality in the Eurozone has actually been falling. It's good news. So in summary, the Eurozone is in a shallow recession, which shows some signs of bottoming despite very high interest rates. Inflation ticked up in December, but the trend remains down. The employment market, though, remains very tight. So it's questionable how soon the ECB will start to cut rates. On to the US, Richard.
Thank you, Keith. So US CPI, we just had the figures yesterday, didn't we?
Yeah.
And that was worse than expected by 50%, actually. Mm-hmm. So instead of being at a roughly annualized rate of 2.4%, it's a roughly annualized rate of 3.6%. I haven't compounded there.
Yeah.
So it's a big difference, and of course has changed expectations to some extent for interest rate, the rate of interest rate cuts.
Yeah.
So there we have it. I mean, it had fallen sharply, hasn't it? Now it seems to sort of leveled off at the moment at between 3 and 4%.
Yes.
And the sort of core CPI was at 0.3% month on month. And year on year, it's 4%, just below 4%, which the Fed considers, and I consider too high. I mean, part of the problem also is if it starts to go back up from 4%, you've got a significant problem.
Yeah, you've got a big problem then. Go on.
So what were the big elements of it? So there was used car payments, prices even, and electricity prices were two big elements of it. And so we've got this big fall in used car prices.
Well, the thing is, Richard, the point here is they're showing a rise in new car prices.
Yeah.
But actually,
it's lagged. Yeah. So I mean, the statistics are a bit dodgy, isn't it? It's like as we've discussed many times before, the owner equivalent rent for rent.
Yeah. Well, more on that coming up, mate.
So US food price inflation continuing to fall hard.
Yeah, that's great.
And these are the main contributors to the overall change in CPI. So you can see that new vehicles are a very small contributor, but owner's equivalent rent actually is a big contributor.
Yeah, it's almost all inflation on a year-on-year basis.
Yeah. So we've got US rents versus US shelter CPI. So we've got shelter in red and rents in blue. And so there seems to be a disconnect between those two numbers.
Yeah.
Significantly.
Okay, so we've talked previously about CPI shelter. So pause read. Shelter inflation, CPI shelter, is primarily driven by owner's equivalent rent. And that is based on a survey of renters, which they do every 6 months, which seems ludicrous. And it asks what rent they're paying. And of course, people sign on for 1-year contracts. So it's not, the latest rents. There's a lag of, up to 12 months in the survey's rents and market rents. So you're sampling every 6 months, and the data you've got is going to have an average lag of about 6 months. So, of course, CPI shelter really lags what's happening in the market. And if we return to the chart, you can see CPI shelter is 6.2%. Actually, market rents are currently falling, and we know that a whole glut of US apartments are coming onto the market, which will tend to depress rents further.
So core CPI ex shelter was actually just 0.2% month on month.
Yeah, so much less worrying.
Yeah, not far off target. And then we've got core services here that, excluding shelter, which is at 4%, known as super core inflation.
Yeah, now that is a concern. That's not coming down.
No, it's stuck a little bit, hasn't it? So the trimmed mean Cleveland Fed is also sticking at 4%. So there's clearly some stickiness in the inflation in the US, and the next few months will show whether it rebounds or whether it resumes its downward trend, or even if it stays still.
Yeah.
So the Atlanta Fed wage growth tracker has stopped falling at 5.2%. And US non-farm payrolls were better than consensus expectations, and at 216,000.
Yeah. Right, we've got a big section on this coming up. Note that November was also revised down.
US hourly earnings month on month increased by 0.4%, which is a 5.5% annual increase.
4.8, isn't it?
Well, I compounded that one, Keith.
Right, okay, right.
Just to
Very
compound.
good. Very good.
Approximation. I think when you're compounding 0.4, you have to compound it as opposed to multiply it by.
Yeah.
What is it? The eighth wonder of the world, isn't it? Compound interest. So US hourly earnings were 4.1%, and again, that's a bit on the high side.
It is. Yeah.
And the US unemployment rate remaining really very low.
Yeah. So the labor market in the US seems to remain very tight. But the unemployment rate fell because 676,000 people left the labor force in December.
The US labor force participation rate is consequently down quite sharply, although it's just like the general trend for labor force participation rate is still upwards. So the US average weekly hours worked is, basically it's sort of oscillating between 34.3 and 34.4.
Yeah, which is interesting because, if there's got a tight labor market, then you'd expect, more hours worked.
Yeah.
And we've got later a chart of full-time and part-time work, and it shows more part-time jobs and fewer full-time jobs. So that would make sense.
Yeah. Permanent job losses falling slightly, and temporary layoffs rising slightly. And here we have a chart showing the monthly employment change by industry, and education, health services, government, and leisure and hospitality were the standouts there, which isn't actually particularly, I think, a sign of a healthy economy. And the change in non-farm payrolls is just on this sort of slowly gentle downward decline.
Yeah.
Average hourly earnings. This is a fairly sort of production and non-supervisory workers.
Yeah.
But anyway, the average hourly earnings are continuing to fall.
Well, I think the important chart is that, the trend in non-farm payrolls is undoubtedly still down.
Yeah.
Okay, so we have previously shown you the non-farm payrolls, which showed a rise in employment of 218,000 in December. And that comes from the Establishment Survey, which is a survey of employers. There's also the Household Survey, which surveys, I think, 60,000 households in the US. And there you get a completely different picture. The Household Survey is reporting a drop in employment of 683,000 jobs in December. So those two surveys showing very different things, as shown here. On the left, the Establishment Survey. On the right, the Household Survey. Now, Household Survey is much more volatile, but has painted throughout 2023 a much more pessimistic picture of the US employment market than the Establishment Survey.
Yeah, I mean, these different data sources, they often have quite different out results, don't they? And so this is a growth in aggregate hours worked. Well, this is a chart of the aggregate hours worked versus non-farm payrolls, and you can see that hours work is continuing to slow down. And
yes.
It's not showing any change in that. And this is quite a long-term chart. I like these longer-term charts because you get a better sense for what's going on.
I think you can say the US jobs market is definitely still slowing.
Yeah, I would agree with that. Okay, so this is showing that difference that we discussed between the establishment and the household surveys, partly a function of double counting of multiple job holders. And the number of Americans holding 2 or more jobs is now 8.6 million.
Yeah. So that shows that there are a lot of people who are in dire financial situation where they feel they need to hold down more than one job.
Yeah. And I mean, this is a nasty statistic in that there's loss of full-time jobs and the gaining of part-time jobs.
Yeah. 1.5 million full-time jobs lost in December.
Yeah.
That's, if the household survey is right, then the US jobs market is slowing.
So there we have it, a statistically significant fall in employment from the household survey and a statistically significant rise in employment from the establishment payroll survey. So one of them, they may both be wrong, but they can't both be right.
Yeah, that's true. Well put.
And we've got this continuing, the history of the non-farm payroll is that it is revised lower.
Yes.
And November's and October's were both revised lower. December will probably be revised lower, won't it?
Yeah.
So think of a number and take off 25%. So, gosh, the whole of 2023, 25% of job gains have been revised away. That's extraordinary, isn't it?
Yeah. Now, this, Richard, you'll like. Because the blue line is their birth and death model, which shows a constant job creation. And then if you subtract the birth and death model from non-farm payrolls, you'll see just this very steady decline in the remainder. So other jobs. So it looks like, non-farm payrolls are actually steadily declining.
Yeah, that is interesting, isn't it? And so new hires are showing quite a big drop actually since biggest since July 2020, but that is suggesting that another indicator suggesting the employment market is slowing down. So this is the response rate for the jobs and the non-farm payroll surveys, and you can see that from 60 to 70% 10 years ago. We're down to 30 to 40% now, which means they must, by definition, be less accurate.
Yeah.
Temporary help in employment continues, is starting. The long-term graph, it peaked very high after COVID. It's back down to the sort of 2015 to 2020 levels.
Yeah. And the reason we're interested in this is when employers start cutting employees, the first people they cut are temps.
Yeah.
And historically, this has been quite a good recession forecaster.
Yeah.
And it's turning decisively down.
It is. And native employment hasn't returned to the pre-pandemic trend, which means that the employment is being supported by immigration.
Yeah.
Prime age full-time employment showing a sharp drop in December, and US full-time employment, which is begun. The point here is it's beginning to fall. Why is it beginning to fall if the labour market is so strong?
Well, it's not just that, Richard, but look at the trend over the last year. You know, the non-farm payrolls have been showing steady job growth throughout 2023. Here, actually, there's been no growth at all in full-time employment.
Yeah. Well, yeah. And it's this part-time issue, isn't it? A lot of jobs are part-time jobs, and they're just counted as a job, aren't they? It doesn't matter whether they're
Yes.
part-time; they're just counted as a job.
Precisely.
So it's not related to hours worked. So US ISM non-manufacturing PMIs, they're bouncing around between 55 and 50, and unless it drops below 50 or goes above 55, I think we could say it's in a steady state at the moment. US ISM non-manufacturing business survey is, again, it's bouncing around between 50 and 60, but it's all bouncing basically in the high end of that range, so that is much more healthy.
Mm.
And non-manufacturing employment, however, is like it's falling off a cliff, isn't it?
Well, okay, so we've just had this whole discussion of non-farm payrolls and difference between non-farm payrolls and the household survey. The ISM non-manufacturing survey would seem to support the household survey in saying that employers have started to really cut back.
And the ISM service employment in blue is falling very sharply again as compared with the private service providing payrolls.
Yeah.
Although that itself is falling.
Well, the point is, over the last year, Richard, actually since pandemic, there seems to be very little correlation between ISM services and actually job creation.
Yeah.
So that's slightly concerning and mystifying.
But if you're using two different sources of information to check that basically your information is reasonably valid, that's breaking down in a number of areas now, isn't it?
It is, yeah.
So non-ISM, non-manufacturing new orders, again, it's fairly stable in the mid-50s. Prices paid is it's sort of currently steady-ish, isn't it? I don't put a great deal of store by expectations because I think analysts aren't necessarily often right, but I think the actual figures are much more important, apart from maybe short-term market reactions. So the ISM non-manufacturing PMI is more pessimistic than the global services PMI. One which is 50, the one which is nearer 40.
Yeah, we've talked about this before. The non-manufacturing includes extractive industries, basically anything that's not manufacturing, whereas the S&P services just looks at services companies. So they do actually have quite different makeups.
So you might expect them to diverge depending on what's going on in the economy.
Yeah, I think a big thing is that ISM non-manufacturing includes oil and gas.
Right. So maybe it tells you more about what's going on in the economy in terms of varying sectoral activity. So the US factory orders month on month is looking healthy. And excluding transport, it's still positive. Obviously, transport was a big factor. Was it Boeing 737 Maxes?
Well, I don't think they're going to be ordering many of those in the near future.
No.
Seems cursed, that aircraft.
Yeah. And US consumer inflation expectations are better than was that which was expected, and continuing to fall.
Great.
Although they're wanting their 4 or 5% pay rises.
Yeah. Doesn't everyone?
Yeah. The NFIB Business Optimism Index looks like it has actually bottomed, may even be turning around. And the RCM TIPP Economic Optimism Index, quite a noisy series, definitely below 50. US consumer credit month on month has had its biggest jump in quite a long time.
Yeah, this is really interesting because a lot of this is revolving credit. And we've got charts coming up later showing that credit card interest rates have now hit an all-time high. So that is not painting a terribly good picture of the US consumer.
Used car prices month on month still falling, but the rate of decline has dropped.
Yes, I would contrast this with, CPI, used car price index, which showed a rise in December. Yeah. And so there must be at least a 3-month lag.
And used car prices year on year, still below zero. Retail sales looking very healthy. We are obviously pre-Christmas.
I think that's into the new year. So January sales looking pretty good.
All right, yeah. And the US mortgage rate is, it's falling. The mortgage market index still, it is just looking very poorly. No sign of any recovery there. Initial jobless claims looks like the jobs market is very healthy.
So returning to this issue of jobs, Richard, the non-farm payrolls, paints a picture of continued job creation and a tight labor market.
Yeah.
Now, if the household survey was right, then you would have expected a rise in jobless claims. However, remember that we've got 600,000 people leaving the workforce in December.
Yeah.
So perhaps, people have left the workforce and retired.
Yeah, which time workforce up.
Yeah.
The continuing jobless claims fallen back a bit again from last week. So
yeah,
up there at the moment, see where it goes. Jobless claims surging in a seasonal manner.
Yeah. So the blue line here is not seasonally adjusted. The red line corresponds with the bar charts we've just shown you, i.e. that initial claims are not rising. But, a lot of people have been claiming. The question now is whether they go back into work in the new year.
And the Dallas Fed Weekly Economic GDP Index, the wiggly blue line, is 2.9. Is that 2.4? Sorry, currently at 2.4.
Yeah. So, according to the Dallas Fed, the US economy is doing just fine right now.
And the Citigroup Economic Price Index.
Yeah. Round about zero.
And the Atlanta Fed GDP now, which I just hate this chart. 2.2% this week.
Yeah. So again, everything's adding up to the US economy is just doing fine, frankly.
Showing capex intentions, which have been falling for the last 2 years and are still falling significantly.
Yeah. And this is exactly what you'd expect with higher interest rates. And that should feed through to falling investment in the coming year.
Yeah. I mean, one of the points is we've had a lot of, we think we've had a lot of malinvestment with such low interest rates. And what's actually happening, that the malinvestment is coming out. bearing in mind that that is a relative graph, not an absolute graph.
Mm.
Interest payment on federal debt increased by 38% in 2023, and it's now really quite a lot of money. So there's the summary. The bottom line, the US economy still seems to be doing fine. And we do see signs, however, that the labour market is continuing to slowly slow.
Yeah. Well, the viewers can make up their own mind. We presented them with a lot of information, but to me, it's that chart which showed the non-farm payrolls broken down into the births and deaths model, and the rest clearly shows that the rest is just steadily declining.
Yeah.
And on to China. Thank you, Richard. So we had inflation numbers out from China this morning, and that came out at 0.1% in December. So very little inflation in China, but month on month, a break from deflation. But the year on year is still in deflation, and that does not paint a strong picture of the Chinese economy. Supply is greater than demand. PPI still firmly stuck in deflation. Chinese balance of trade just absolutely enormous, beating expectations. 75 billion in December alone. And Citigroup Economic Supplies Index is pretty much zero. Now, this year, Chinese local governments are going to need to refinance a record number of bonds, and that's likely to keep on rising because if you look at this chart, this is leverage in China, and it is growing just steadily. And central government, local government leverage continuing to rise. Pause, take a look. So China remains stuck in deflation, and it's reliant on exports for economic growth. And that is unlikely to change while the property market remains weak. Is likely to be exporting deflation. And onto one chart. Now, I thought this was amazing. So this is the profit margins of US companies, purple, Eurozone companies, blue, compared to 1998. And you see they've risen by 40% in the US as a result of tax cuts. And Richard and I previously read a book by Jonathan Tepper called The Myth of Capitalism, which is all about increasing industrial concentration in the US. Basically, the large companies have been hoovering up the small companies, unconstrained by the regulator in the US. So that's leading to fewer companies in key industries, and those big companies then have pricing power, which they can use to raise profit margins. So hence the outperformance of US stocks over the past decade is entirely rational. And briefly onto Greece. So a couple of weeks ago, we showed you this chart, which is Greek unemployment, and shows that after a lost decade, the Greek unemployment is back down to pre-GFC levels. So that paints a picture of the Greek economy doing well. But this week I saw this chart in the FT, which I thought was just shocking. So this is real wages in Greece. And you can see they've fallen by the best part of 30% over the last 15 years. And as a result, Greek GDP is still around 30% below its 2008 peak 15 years later. It's extraordinary. Greece has been suffering a huge depression. And remember, the problem with the Eurozone is it's a suboptimal currency area. And because all the countries in the Eurozone have fixed their exchange rates at 1 with the euro, any rebalancing in national competitiveness has to be done by the real economy. So real prices in the economy, including the price of wages, has to fall. Whereas if they had a floating exchange rate, the currency would just adjust. And that's exactly what's happened in Greece. I mean, frankly, I'm just amazed by the ability and the willingness of the Greek people to accept this ongoing depression to remain part of the Eurozone.
Inflation watch. Thank you, Keith. So new data, we've got the US and the EU, 3.4% CPI in December for the US, which was up, and 2.9 CPI in the EU, which was also up, although core CPIs were down for both months. And there's no change in interest rates in either economic area. So the ECB has said that excess demand was not responsible for the rise of inflation during the pandemic, and it has decomposed the shocks here caused by
the logical imputation from these charts, Richard, is that all the inflation in the Eurozone was caused by supply shocks, none of it by demand. So why on earth are the ECB keeping their interest rates high? They're presumably to stop inflation expectations getting out of control. But this would seem a precursor to the ECB saying they don't need to keep interest rates high.
Yeah, possibly so. It very much depends, doesn't it? I suspect we're heading for another supply shock inflation with the situation in the Middle East.
I hope not.
Yeah, well, I hope not too, but I suspect that we are. So this is a US trueflation, which is just above 2%.
Yeah, i.e. very close to target, frankly.
Yeah. And UK trueflation, which is about 3%.
Yeah, and that is great. That's just an absolutely amazing chart.
Yeah. The US missed its inflation expectation, but actually there is no particularly inflationary pressure in the US or in the UK or in Europe, but there is, except in wage rates.
Well, labour markets remain tight, and I think you can say that service inflation everywhere is sticky. But the trend in core is definitely coming down. And if you look at the 3-month annualized, then everywhere inflation is quite low.
So, recession watch. Do you think one day we'll have a boom watch, Keith?
Well, I fully intend to. Yeah, I hope so, because I hope we're going to have a serious recession before then, which will bail me out of my disastrous bond trade. And then, then we'll turn to boom watch, as I've get into equities far too early and, lose vast amounts of money. But anyway, there you go.
So the San Francisco Fed's proxy Fed funds rate remains elevated. So the proxy Fed fund rate is about 6.5%.
Yeah.
The effective rate is 5.5. The rates are high, is what we're saying.
Yeah.
Has tax capex started to peak? Well, maybe I would say, obviously, it has risen very significantly, hasn't it, since the early 20s, and we've had this huge rise, which I think was, as we know, the CHIPS Act and the Inflation Reduction Act. Has it peaked? Well, we'll see, won't we?
I think it has. I think logically, there's a huge surge in investment funded by cheap money. And I think that's now being spent.
It'd be interesting to see this chart in 3 months' time, wouldn't it?
Yeah.
It really would be. And the Druckenmiller recession proxy is continuing to indicate a slowdown. And it is actually, however he calculates it, it is the performance of cyclicals. It's looking pretty poor.
Yeah, I'm looking at this though, Richard. thinking this is a bit shit. It's like, because here, if you look at 1999,
Yeah.
a recession did come along, but it was like a year later, by which time, I suppose, what it says, actually, I'm not sure what it says at all, actually.
It says that at some point when this thing gets below zero, there will be a recession before it goes above zero,
Yeah.
except for 1994.
You heard it here first.
And only around half of US consumers. Sorry. That's why people watch these.
Yeah, exactly. It's for our penetrating insights, mate.
Only around half of US consumers can pay off their credit bill each month, and we've just seen this huge rise, 23 billion, and that is that's a very uncomfortable statistic, I would say.
Yeah.
So the strength of the US housing market, 85% of Americans think it's a bad time to buy a house, the US housing market is firing on all cylinders.
Yeah, I know, mystifying.
And global manufacturing has been in recession, slowing, contracting for a long time, for a year and a half.
Yeah, 18 months.
Yeah. So if you look at the sales numbers from the NFIB, you can see that US small businesses are actually in a recession.
Yeah.
But what isn't in a recession is big tech, clearly.
Yeah.
I think the reshoring of a lot of that manufacturing we've discussed in the past is boosting the US economy as well. But US small businesses are still planning to hire, even though they are technically in a recession.
Yeah. This isn't a great number, but, it's higher than it was a lot of post-GFC period.
The US office vacancy rate is actually looks like it's on a fairly rapid uptrend, as well as just hitting a new high. And I think you can go from living easy memories from the 2000s. We know what sort of, I have a sense, anyway, I do have a sense of what's happened since 2000, much better than I do in the 1980s. That is not a happy figure for US office owners.
Yeah,
and I'm sure
exactly.
So this is apocryphal. I work 1 day a week out of a WeWork office in London, and it's so quiet.
Yeah, absolutely. There are big losses to be taken on commercial real estate coming down the pipe.
So US office prices down 40% from their peak, and that downward trend is still intact. So the Joshi rule, which is a real-time US recession indicator. And I won't read through all of that, but what it is saying is when it reaches the line called recession event horizon, the US will then be in recession. And it's not far off it, and it's heading up quite quickly.
Yeah. To be fair, we have covered a load of these recession indicators, which seem to be pointing towards recession and then turn down again.
So at the current rate of climb, so at the current rate of climb, Keith, this is going to, the US will be in recession in about mid-March.
Yeah. Here's hoping, frankly. But
the SARM rule is no longer heading towards a recession. And there we have the definition of what the SARM rule is. So the US has avoided a recession.
Yeah.
Soft landing, here we come. And the decline in real-time job postings is slowing. So after seasonal adjustments.
Yeah. So the question is, there's been a big drop-off in job postings. Will they come back in the new year, as they normally do? But if the economy is slowing, they might not. So next few months' data is going to be quite useful and interesting.
Yeah, I think so. I think we're sort of heading towards the denouement, to be honest. I would say that by the end of this coming summer, we'll know.
Yeah.
Credit card fees continuing to rise to all-time highs, just as we know the credit card debt is increasing, and obviously the banks make out like bandits on credit cards.
Yeah. And we've seen that consumers have been borrowing a load on their credit cards, and 50% of them are not confident they can pay it off.
So we've got these restrictive interest rates. We've got resilient economies. Keith and I still expect that there will be a recession.
Yeah. We've been saying that for a very long time. Okay. So thank you, Richard. Now we have a couple of segments coming up on energy. And first of all, shale oil. And thank you to Simon W. for his help in this. So, first of all, world oil demand. Now, all the indications are that world oil demand is not slowing with the energy transition. So, all the forecasts are that it will keep on growing over the next couple of years. Reminder, India and China still use much less oil per capita than Western economies. And as they develop, so their appetite for oil keeps on rising. In Europe, in particular, and the US, oil demand peaked quite a long time ago, but oil demand is now shifting east. And so over the next 2 years, the EIA are forecasting a rise of 2.8 million barrels a day in global oil consumption. So we are going to need more oil. And over the last few years, pretty much the vast majority of new oil production has come from the US. And within the US, it's all been shale. And Permian Basin, in particular, now produces 46% of US oil supply. So very dependent on shale and very dependent on the Permian. Now, the reason we're doing this section is that Art Berman, the US oil analyst, has been looking at the data coming out of the Permian, and he is saying that new wells in the Permian, their productivity is dropping rapidly. Okay, so this is the production curve for US shale oil wells from the Permian. And what it shows is the production of an average well. The x-axis is months after it was first brought into production, and the y-axis is daily production. And so you can see new wells, they take a few months to reach peak production, and then there's quite a rapid decline. Now, you're looking at the red line, and you'll see the red line seems to be dropping much more sharply than the tan line, which is 2021, or the black line, which is 2022. And that drop is really important because what it means is the ultimate expected recovery rates from the Permian wells are dropping. And so this is a table that he's put together showing the EUR is estimated ultimate recovery. And he's showing that in the last 2 years, the estimated ultimate recovery of new wells has dropped very substantially. And that means that he thinks the break-even rate for new wells in the Permian has risen very substantially and is now at $83 a barrel, which is well above where WTI currently is. So if Art Berman is right, that means that oil prices would have to rise very substantially, and the US would have to drill a lot more wells in the Permian just to even maintain current production.
So, Keith, is there enough space in the Permian to drill that many wells? How much is untapped, as it were?
There is. So let me carry on for a bit. And Art Berman is saying that part of the problem appears to be that well bores are too close to each other. So the wells are interfering with each other. And in core areas, the well bores are only 300, 400 feet apart. In places less than 100 feet, you can see that here where they all overlap. And optimal spacing requires separation of around 600 feet. So he's saying that essentially you're drilling far too close together. And this is from Josh Young. And he is also showing that oil productivity per new well is dropping sharply. So this is per 10,000 feet of lateral. And so you're seeing new wells in the Permian are less productive than they were. But the EIA is forecasting US crude oil production essentially to kind of remain at these levels to around 2050. So, and all of that is tight oil. So conventional oil is forecast to decline slightly to be replaced by increased tight oil production. So the EIA thinks that there is lots of resources in the US which can continue to be produced. But of course, it says nothing about the price at which it expects these resources to be produced. So the Permian comprises two basins, the Delaware and the Midland. And this data is from 2022, and we've talked about this previously. According to Shale Profile, there has, up until 2023, and we don't have data for that, there has not really been a reduction in well productivity per 10,000 feet, in part because they've used huge amounts of proppant. The amount of proppant they've used has gone up tenfold. But I have tried to look at the data myself, and this is from the Shale Profile website. And what it shows is that the new data for 2023 is quite sparse. So the thickness of the line is the number of wells. And over time, you get more data. So the data so far, there's not much of it on which to draw definitive conclusions, unless Art Berman has better data source than I've got, which is perfectly possible. The data from Shale Profile, which is quite sparse so far for 2023, only covers wells up to July 2023. Of those, if you look at the average daily production 6 months in from those new wells, and you compare them to wells drilled in previous years 6 months in, then this is what you get. And it shows there has been a drop-off in well productivity, nowhere near the 38% drop that Art Berman is reporting over the last 2 years. And if you look at the EIA's numbers, and now this is new well oil production per rig, which is quite an odd statistic. And so if rigs are drilling more wells, then productivity per rig will tend to rise. And they're showing productivity per rig is rising. And reminder, last year, US shale production massively beat expectations. The expectations were that the US would end the year at about 12.5 and actually ended the year at 13.3. So US shale, grew substantially last year. And if Art Berman is right, and shale wells last year were much less productive, then how come US oil companies kept on drilling? And all that growth in US production was achieved despite a falling rig count. The pink line is falling rigs. Now, the shale revolution is a technology revolution. And there's an article on Bloomberg discussing this and saying that how wells now take only 11.5 days to drill, whereas in 2019, they took 19.5 days. So that is a huge drop in the amount of time it takes to drill a new well. And there have been similar improvements in recovery rates. So as long as technology continues to improve, then there is a big resource out there. And I think it would be unwise to bet against the US oil industry. They have always managed to find a way. However, HFI research are currently forecasting that US oil production has peaked for now. But the EIA is forecasting that it will rise in 2024 and again in 2025. So in summary, Art Berman is saying that Permian wells are becoming substantially less productive and their ultimate recovery rates have fallen very substantially over the last couple of years. Now, if he's right, that would have huge implications for US shale. They'd have to drill a lot more wells and at a lot higher price. And that means that as the US shale is the marginal supplier for the world, that oil prices would rise very substantially. But I can't corroborate his data currently. I don't see anywhere near that level of drop-off in oil well productivity. And the bottom line is that the rig count, as you'll see, is stable and has actually ticked up last week. So if US shale wells really were unprofitable, then why would they continue to be drilling them? I suspect that he's working off an incomplete or bad data set. But whatever happens, it would seem that shale oil productivity has peaked. And that means that to maintain production, they're going to have to drill longer wells, more of them, frack them at shorter intervals, and use more proppant. And that means that actually the service companies may be the ones you want to invest in when the oil price bottoms. And I have listed here some oil service companies who would benefit from the increased drilling activity. And discussion of the future of oil production and the energy market brings me on to natural gas liquids. Now, before we get going, a big thank you to Simon W., Orange Cannon, and Uncool Tom from our Discord, who really helped me with this. They're oil and gas professionals, whereas we're the amateurs. So what are natural gas liquids? Well, they're longer chain hydrocarbons. Remember, natural gas is CH4, methane, and they are longer chain than methane, and they can be separated out from the gas mix and used. Now, the longer chain hydrocarbons, isobutane, pentane, and pentanes plus, can be fed into refineries and refined into gasoline. So CH4 is natural gas. Then you have liquid petroleum gases, which are propane, butane, and isobutane, and then heavier fractions in particular are used in refining. But the vast majority of NGLs comprise ethane and propane. Ethane is mainly used in the petrochemicals industry to produce polyethylene, and a big precursor to lots of plastics. Propane is mainly used as a heating fuel. But you'll see the parts of NGLs, the fractions of NGLs which are fed into refineries comprise a relatively small portion of NGLs. And so only around a maximum of 70% of NGL production can be fed into refineries. Now, back in the day when the shale revolution was just starting, all these shale oil wells are out in the country, and they're quite small. So there was no infrastructure to bring the associated gas and the associated NGLs from oil wells into the system. And a lot of it was simply burnt and flared off. But that has changed over the years. And there are now natural gas pipelines that take the gas from all these individual wells and feed them to refineries and processing plants on the Gulf Coast. And actually, there are going to soon be dedicated natural gas pipelines that take the NGLs to the coast for refining. And if you look at the network of little blue lines, those are the gas gathering lines that connect to each individual well and make sure that that gas now comes to market rather than simply being flared off. And so by 2025, you'll have 5 new pipelines taking 1.1 million barrels a day of NGLs to the coast for processing. And the surge in NGL production in the US has been absolutely amazing. So in 2010, the US was producing 2 million barrels a day. In a decade, it's trebled to over 6 million barrels a day currently. And the US oil production of 13.25 million barrels a day only includes that portion of NGLs that goes into refineries, not the rest. And here we have how the EIA accounts for natural gas liquids. And so the US produced 6.6 million barrels a day in December. Of that, just under 700,000 barrels a day was counted as crude supply. And a lot of these NGLs are being produced in the Permian as a byproduct of oil production. And as the shale oil wells age, they produce more gas than oil. So as the oil wells decline in production, the fall in their gas production will be less marked than the fall in their oil production. And you can see here that natural gas production from the Permian just continues to relentlessly rise, and with it, NGL production. And globally, natural gas production is rising and NGL production is therefore rising. Not all shale oil wells are equal. Some areas have much higher, some areas are wetter, so produce more NGLs. And so this is charts of the Appalachia shale region. And although natural gas production from Appalachia is forecast to keep on rising, there will be exploiting areas outside the core which are drier and have less NGLs in future. And this is a chart showing the US petroleum system as of 2019 and what goes into the whole system and what comes out. And you see down the bottom here, we have NGLs, 4.2 million barrels a day as then was. But then only 0.57 million barrels a day were used in refineries, and the rest was direct use by industry. So ethane going into petrochemicals, propane and butane going into heating. When you start accounting for the use of NPLs in the petroleum system, you've got to remember that if you count them by barrel, they are much less energy dense than crude oil. So a barrel of liquid petroleum gas, for example, has only around 2/3 the energy density of crude. So barrels a day can be a slightly misleading statistic when you talk about NPLs. And natural gas prices are very low in the US. So the price of natural gas is only around 16 barrels a day currently, if you're equivalent to crude. But natural NGLs trade at a decent premium to natural gas and trade at around 40 barrels a day. Reminder, crude price is about 75 currently. So all this adds up to Doomberg's argument that the US actually has an abundance of energy. And there is no evidence that we are close to peak cheap oil. Natural gas liquids production is growing and is not fully accounted for in the energy system. It's not counted. Most of it is not counted in barrels per day, and all of it is used. And where it is used, it displaces other products from the refinery. So as NGLs, the ethane in NGLs gets used by the petrochemicals industry, so refineries don't have to produce ethane. They produce other stuff. So bottom line is that there are loads of hydrocarbons, and the industry is adept and flexible at using all these hydrocarbons, with the result that in the US, oil and gas production is at a new all-time high and continuing to rise. There is no evidence of peak cheap oil and energy. We are entering a period of energy abundance. Don't expect the oil price to rise, is his argument. Well, our view is that only around 10% of natural gas liquids are the pentanes and heavier hydrocarbons used by refineries. Most of the other components are used in the petrochemicals industry. So the main use of crude is in transport, and only about 10% of NGLs is suitable for transport use. So what really matters still is the production of crude. And we're in the previous segment, we were talking about Art Berman's argument that shale wells had peaked. That shale oil production will remain the most important part of the energy mix. So I'm not convinced that Doomberg is right. A lot will depend on the productivity of shale oil wells and the price at which they can produce that oil. So something to watch going forward. NGLs, the growth in NGLs has been extraordinary and is something that I hadn't previously really been aware of, but it seems a stretch to be forecasting a period of energy abundance just on the rise in NGLs. Richard, do you have any thoughts?
I think it's really interesting, Keith, what you've gone through. I think peak oil is being predicted constantly. It has been predicted for a very long time, hasn't it? And every time peak oil is predicted, the oil industry finds more oil, more ways of extracting, harder to extract oil, better ways of using it. It becomes more flexible, more capable of exploiting the discoveries to the full. It's human ingenuity, isn't it?
Yeah.
I think it's fascinating. And what it also says is that whilst, unless there's some huge disruption to the oil supply caused by problems in the Middle East and so forth, it says that we're not going to reach peak oil anytime.
Yeah. No, I agree. I mean, my final thought really is that, we know OPEC's got 4 million barrels a day of spare production. Yeah. There's no shortage of oil. And, I think Doomberg is right that there's big resource still out there to be exploited. The question is, Art Berman is saying that the core areas of the Permian have now been drilled out, and you're going to be moving into less productive, more marginal areas. And you're going to need to keep on improving the technology to keep the price at which that's produced down. Now, can they still do it? You wouldn't bet against them. And currently, the oil price is going nowhere. And with 4 million barrels of spare production, if we do get a slowdown in the world economy, then I continue to think at some stage Saudi gets fed up with basically supporting the entire market and decides to open the taps and teach everyone a lesson, just as it did last time.
Yeah, I agree. I think it's a really difficult game to predict the sort of geology of these and how the industry is going to respond. I think it's because it's multi-dimensional. It's very, very difficult.
What I'd say about last year is everyone was predicting a 2 million barrel a day deficit by Q4.
Yeah.
Didn't happen.
No.
Forecasting tightness in the oil market, it seems to be a total mug's game.
And also you've got things moving in two directions. So you've got the less economically developed countries increasing their oil usage, fossil fuel usage, and we've got the more economically developed countries rapidly trying to reduce their oil usage or fossil fuel usage. And they trying to compute the relative rates of those changes, I think is impossible. Like every time you get a windmill, there's going to be a little bit less gas burnt in the UK, and we're nearly.
Yeah.
It's really, really, really difficult, I think.
Yeah. So, I fully intend to buy back into the energy complex when prices collapse. But, only when prices collapse. I think buying them at any other time, like now, I just don't know. There's too much uncertainty.
Yeah, I agree.
And on to soft landing watch. So the easing in financial conditions has been extraordinary, although they've tightened a bit recently, and that will help support the economy. And we've talked previously about the rise in US bankruptcies. Well, if you take the long-term view, that rise is only back to factually more normal levels. And interest expenses are really low because, as we've talked about many times, corporates in the US have locked in low rate borrowing from during the pandemic. And so they have yet to experience the rise in interest rates. But talking about bankruptcies, this is from the FT, and you see that actually in some sectors, you really have seen a rise in bankruptcies, computers and software, chemicals, and medical. But in others, such as oil and gas, they're very low. Retail's actually below last year. So bottom line, US is doing just fine right now, frankly, with little sign of a slowdown, although, we continue to believe the jobs market is slowing. Briefly, the adoption of tractors. Now, when tractors were invented in the 1890s, they had a huge advantage over the traditional method of using horses and mules. They were more powerful, they were more versatile, they did not need much maintenance, and they freed up around 1.5 acres of land per horse that otherwise needed to be grown for feed. So if you got a tractor, you could grow cash crops on much more of your land. So adding to both the production and your revenues. So how come then that by 1940, just 23% of farms in the US had got a tractor? Technological adoption of the tractor was really very slow. You can see from the chart at the bottom here that really it took until the 1950s and 60s for the tractor to become fully adopted by the US agricultural industry. Now, the reasons for the slower adoption were despite the headlines, the early versions of the tractor were less useful than they appeared to be because they had metal wheels and they got stuck in the mud. And so you had to wait for the invention of rubber tires before they became more useful. And changing the plows, etc., is all very hard work. Required many men until the invention of the power lift. And some crops, such as corn and cotton, could not yet be picked. And during the Great Depression of the 30s, labor prices fell. And so it was easier to hire a few men to look after the horses than spend money on a new tractor, a big piece of capital investment. And it's only after World War II when wages rose that tractor adoption rates also rose. And the final point is that tractors work best on big fields. So in order to fully use the tractor, get the best out of it, you had to restructure the entire farm, which took time. Now, why are we talking about this? Well, the point is that new technologies take a long time to be fully integrated into the economy, typically around 20 years. In the case of tractors, it was more like 50 or 60. And every time there's a new technology, the stock markets become a bit overexcited, starting with the railway manias of the 1940s. And so we're currently very excited about AI, but the reality is it will take a long time to be fully integrated into the world economy. And it's always easy to get overexcited. So beware. And onto other charts. So a reminder that the consensus is often wrong. This is the consensus from December 2022. And then the overwhelming consensus was the US would be in a recession in 2023. And I very much bought into that, reading the data. And I also was completely wrong. And there's been much talk about how globalization is reversing. Well, there's no evidence of that in the data, really. Globalization has stabilized at a very high level. And as you've just seen from the Chinese trade balance, they are exporting as much as ever. The bubble in second-hand watch prices has very much collapsed. So beware investment fads. And on to good news. So this weird-looking creature is a saigu, which are native to the steppes of Central Asia, and their numbers had fallen as low as 48,000 in Kazakhstan, which is their main, which is where they're mainly found. But thanks to conservation efforts, their numbers have now rebounded to 1.9 million, which is great. Looks tasty, I'd say. And onto equities. So the world index had a decent week, up 0.8%. That's down slightly on the year, but seems to be resuming its trend upwards. The all share continued its underperformance, down 0.9% on the week, down 1.3% year to date. The Euro stocks also had a poor week, down 1%, down 1.3% year to date. It's the US that is once more propping up the world equity indices. So the S&P was up 1.4%, as positive on the year. The Nasdaq up 2.7% on the week, although down a touch on the year. Russell 2000, though, it continually aims for the 2000 level and then can't maintain it. It is falling back again, down 3.6% on the year. The Hang Seng falling further, down 2.4% on the week, down 4.7% year to date. And that does not paint a picture of a healthy Chinese economy. The Topics, however, has had a rip-roaring start to the year, up 4.8% on the week, up 5.4% year to date. Bitcoin did very well during the week on the back of the approval of the Bitcoin ETFs, up 3.8%, up 8% year to date in week 2. Sterling had a good week, up 0.6%, up 0.2% year to date. The euro had a good week, up 0.3%, but down 0.7% year to date. The dollar index down a touch during the week, up 1% year to date. VIX going absolutely nowhere, no volatility to be found, astonishingly low. Down 8.6% on the week and just at really low levels. So there is a big disconnection between the steadily declining labor market in the US and the performance of the S&P. Historically, the two have had a decent correlation. That correlation has broken down. Will it reconnect by an improvement in the US economy or the US equity market taking a bath? Now, we are in an election year in the US, and election years actually tend to be better than average years since 1950. So is the S&P destined for another decent year? 2023 saw huge flows into money market funds. So there's still a lot of money sitting on the sidelines, waiting to flow either into bonds or equities. And this is the distribution of S&P 500 returns over the last, best part of 100 years. And you'll see 2023 was a good year. And the distribution is very much skewed to the positive. Now, this is just an absolutely amazing chart. So the second bar from the top is the market capitalization of the Magnificent Seven in the US. And their capitalization is bigger than the capitalization of any other stock market in the world apart from the US. Just astonishing. Now, the percentage of US households owning stocks continues to rise. And we previously talked about how the US economy is increasingly financialized. So the rise in the stock market in the US will have bolstered the wealth of a lot of US households. And as long as the S&P 500 keeps on growing, then US citizens, US consumers will feel fairly positive about their wealth and will continue to spend. The danger is if there is a downturn in the stock market, then the reverse will occur. And could that then drive the US economy into recession? So far, the US equity market is holding up remarkably well. And again, against expectations, US buybacks were astonishing last year, despite very high interest rates. Positive January tends to mean a positive year. And this is from Simon W. on our Discord, who, despite my relentless pessimism, has a big position in the NVIDIA and did incredibly well. So, might prefer to listen to him rather than to me. And onto commodities and energy commodities. And the tensions in the Middle East meant that oil bounced last week up 2.7%, up 3% year to date. Not a huge rise. WTI up 3.3%. Some numbers specific to the oil market. Well, the US has started the year with decently sized builds. Already, US inventories have risen by 18 million, including the SPR. US crude production has ticked down from its recent peak at 13.2 million barrels a day, which is still enormous. And the Baker Hughes rig count is rising, up 1 to 501. So that would seem to suggest Art Berman is not right, that shale oil drillers are profitable at current prices. Currently, OPEC's spare capacity is the best part of 5 million barrels a day. If OPEC were to open the taps, it would flood the oil market. And they're forecast to maintain that spare capacity into the foreseeable future. Moving on to natural gas. Natural gas in Europe fell 6.2% on the week despite the cold snap. That is all good news. And in the UK, fell 8% on the week despite the cold snap. So that's great for UK inflation. US natural gas futures, however, rose sharply, up 14% on the week, up 30% year to date. Coal prices up 1.8%, but still down 10% in the last 2 weeks. Uranium continues its relentless rise. And onto industrial metals. So generally a very poor week for industrial metals, giving back some of their gains of last year. So I'm afraid I've slightly messed this up in that the weekly numbers all appear to be wrong, and it's the year-to-date numbers that we should be concentrating on. So year-to-date, aluminium has fallen 6.1%. Cobalt is unchanged. Copper is down 2.1% year to date. But reminder, the outlook for copper is really bullish. Demand is forecast to double over the next 25 years. Where will all that copper come from? The long-term outlook for the copper price is surely bullish. Chromium down 2.2% year to date. Iron ore sank last week, and I'm going to read this out. Prices for iron ore cargoes with a 63.5% iron content for delivery in Tianjin sank to $136 a ton, extending the decline from 20-month high of $145, as decreased margins for Chinese steel mills raised expectations of lower input buying. Persistent macroeconomic headwinds for the country and uncertainty over demand for construction materials in the year ahead tempered oil demand from steel mills and countered added buying activity in their usual restocking season. Lithium going nowhere, down 1% year to date. Neodymium falling off a cliff further, down another 9% year to date. Nickel going nowhere, down 1.9% year to date. Tin down 4.7% year to date. Ferrovanadium actually had a bit of a bounce last week, showing signs of life, up 3.8% year to date. And zinc down 5.6% year to date. Okay, on to precious metals. So gold was indifferent, flat on the week, down 0.6% year to date. Silver flat on the week, down 5% year to date. Platinum had a bounce late last year, and that is fully unwound, down 5% year to date, down 4% last week. Rhodium, is that signs of life? Up 0.6% last week, 0.6% year to date. Palladium, dying, down 3.4% last week, down 17% year to date. And onto rates. Well, so in Q4 last year, there was a lot of optimism about the speed of interest rate cuts, and that has unwound quite sharply over the last couple of weeks. So the whole yield curve has shifted up and is pretty much unchanged from a month ago now towards the back end. US similar, but not as marked. And so when you compare the UK and US yield curves, the really odd discrepancies between the two. The 20-year plus, you get a big yield premium for investing in the UK compared to the US. Now, the Fed is forecasting neutral rates of around 2.5%, whereas the market is forecasting that US rates will normalize at around 3.4%. And so the rise in bond yields can be attributed to The market expecting equilibrium interest rates to settle at around 3.4% now. And the market is still expecting 5 rate cuts by election day, which seems optimistic unless the US really does slow down. So this is the UK bond yield. It's having a good day today, but it's risen a lot from earlier in the month. The 30-year has risen very sharply from earlier in the year, although it's having a good day today. And that has been terrible for me. The US has risen from its lows, but actually not that much. Nowhere near as much as the UK. Germany, yields coming down again. Italy, Greece. And concluding comments. Well, interest rates remain restrictive in the UK, US, and EU, and the EU is in a shallow recession. The UK economy is stagnating. The US economy remains resilient, but the labour market continues to slow. We continue to expect that the lagged effect of higher interest rates will slow the economies further in the coming months. And finally, my performance, I'm afraid Richard has had to go. So you just have my performance this week, and it's been absolutely shockingly bad. And so the bond market sold off hard, and I've got totally stuffed, down 5.2% last week, down 9.1% year to date. Once again, underperforming just about everybody and everything at the start of 2024, having had a poor 2023. What the last month has taught me is that when interest rates start being cut, this trade starts to pay off. What's happened over the last few weeks, as you've seen, is that the markets have rode back on some of their expectations for early interest rate cuts, but eventually interest rates will be cut. You've seen that interest rates everywhere are restrictive, and the EU economy is in recession, the UK economy is stagnating, and the US economy is slowing. So at some stage, rates will have to become accommodative. And at that point, this bond trade starts to pay off. So far, it's been a total disaster. And I will be doing a my worst trade on this particular catastrophe when I get out of it. But I still believe that economies will slow down under the influence of higher interest rates. And I think after this week's data and the US labor market, it's clear to me the US labor market is slowing. So I still think that there will be a recession, at which point rates get cut hard and I get paid out. Okay, thank you all for watching. Please can you press like and subscribe to the channel. Reminder, we've now got a 2-week break, but next week we will be producing a Lessons of 2023 podcast, which should be out next Friday. I hope you'll check that out. So in the meantime, it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.